All right, today we're diving into one of the most fundamental decisions a company has to make. What on earth do you do with the profits? It's a huge dilemma that sits right at the heart of corporate finance, and we're going to break down exactly how they figure it out. It really all boils down to this single question. A company works hard, it succeeds, it generates a pile of cash. So, what's next? This choice is going to define its future and its entire relationship with its owners. And what it comes down to really are two basic paths. Path number one, pay out the cash right now to shareholders as a dividend. It's a direct thank you for their investment. Path number two, reinvest that money back into the business with the goal of making it even bigger and more valuable tomorrow. And this right here is the perfect way to look at it from your perspective as an investor. Your total return comes from just two things: the cash dividend they hand you and the capital gain you get when the stock's price goes up. So for the folks in the boardroom, the question is always, which levers should we pull? Do we give you cash today, or do we use that cash to try and make your stock worth more tomorrow? It is a constant balancing act.
Now, you'd think this decision is like everything, right? But believe it or not, a couple of Nobel Prize-winning economists, Modigliani and Miller, came up with a theory that basically turned that whole idea on its head.
And their conclusion was pretty shocking. They said that in a theoretically perfect world, it makes absolutely no difference whether a company pays a dividend or not. The value of the business, it stays exactly the same, regardless. So here's the logic behind their theory, and it's actually pretty elegant. If a company pays you a higher dividend, that's the D1 here, it has less cash to reinvest. That means its future growth, the G, has to go down. Modigliani and Miller argued it's a perfect zero-sum trade-off. The extra cash you get in your pocket today is perfectly offset by the lower growth tomorrow, leaving the total value of your investment completely unchanged. Okay, but here's the huge catch, right? This whole beautiful theory only works if you assume a perfect market. I'm talking no taxes, no fees to buy or sell stock, everybody knows everything, and managers are perfect angels who always do the right thing. And as we all know, the real world, well, it isn't anything like that. And that's why we have to get back to reality. Because all those little imperfections, they're exactly what makes dividend policies so incredibly important. In the real world, this decision is far from irrelevant. In fact, it's one of the most powerful signals a company can possibly send. So we're going to look at 4 big reasons why this decision has so much power in the real world, starting with the very simple fact that, moving money around isn't free. First up, transaction costs. Think about it. If a company doesn't pay you a dividend and you need some cash, what do you have to do? You have to sell some of your stock, and that costs you money in fees. And it works the other way, too. If a company pays out too much cash, it might have to go out and raise more money later, and that costs them a fortune. And because of those costs, you get what's called the clientele effect. Basically, different investors want different things. So you have retirees or pension funds that need a steady check, and they flock to stable, high-dividend companies. On the other hand, you've got young investors saving for the long haul, and they want companies that are going to reinvest every penny for maximum growth. Second, you've got taxes. Of course, right? The government always gets its cut. And very often, the tax rate on dividend income is different from the tax rate on capital gains. That simple fact can create a huge preference among investors for one strategy over the other. Okay, number 3. And this one is absolutely huge. It's something called asymmetric information. It sounds complicated, but the idea is super simple. The people running the company know way more about its real health and its future than we do on the outside. There's an information gap. So how do you bridge that information gap? Well, that's where the dividend comes in. It's not just cash, it's a signal, a really, really powerful signal. When a company increases its dividend, management is shouting from the rooftops that they are confident about the future. And when they cut it, well, that's one of the worst signals they can possibly send. And last but not least, we have agency costs. All this means is that there's a risk that managers won't act in the best interests of the owners. With a giant pile of cash just sitting in the bank account, there's always the temptation to spend it on pet projects or fancy acquisitions that don't really help shareholders. So, how do you keep everyone focused? A strong, consistent dividend policy acts as a form of discipline. If the company is committed to sending that cash out the door every quarter, there's just less money lying around for potential misuse. It forces management to be really careful and disciplined with the funds they have left. Okay, so knowing all this, how do companies actually decide what to do? Well, it turns out there's a kind of corporate playbook, and it usually maps right onto a company's life cycle. When a company is just starting out in its birth and growth phase, it's like a hungry teenager. It needs every single dollar it can get to grow. So dividends, forget about it. They're reinvesting 100% of their earnings back into the business. Then, as the business gets a little older, a little more established, its cash flows start to even out. It doesn't need to pour every lost cent back into growth anymore, so it can start paying a small or maybe moderate dividend. It's a signal that it's reached a new level of maturity. And finally, you get to full maturity. The hypergrowth days are probably in the past. These companies are now cash-generating machines, and at this point, their main job often becomes returning that cash to shareholders through big, reliable dividends. But across all these stages, there is one golden rule, one guiding principle that managers hold sacred when it comes to dividends. A Harvard economist named John Lintner figured this out. He found that managers are terrified of one thing: having to cut a dividend. They know the market sees it as a horrible signal, so they'd rather keep the dividend stable and predictable, even if it means not raising it as quickly as earnings are growing. And this chart just shows it perfectly. I mean, look at this. The blue line, that's corporate earnings. It's all over the place, right? Up and down with the economy. But that red line, that's the dividends. See how much smoother that is? It's that unspoken promise in visual form. The world might be crazy, but management will do everything in its power to protect that dividend and keep it stable for you. Which, of course, brings us to the biggest question for the modern economy. For decades, this has been the playbook. But what about today's tech giants? The companies sitting on literal mountains of cash. As they mature, are they going to become the new dividend workhorses, just like the classic companies before them? Or are they going to write a whole new playbook? It's a multi-trillion-dollar question, and frankly, the jury is still out.